It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. This is the program that takes the mystery out of your financial life. I am your host, Jill Schlesinger. I am the CBS News business analyst. I'm also a certified financial planner. And we are here trying to help you make better or less bad financial decisions. We do that by asking you to do a little bit of work. Go to our website, jillonmoney.com, click the Contact Us button, and write us a note. That is the email we receive. If you'd like to join us live, check the box and Mark will arrange to bring you on the program with us. Okay, let's get started. This is an email from Cindy, who writes, a coworker just shared some disturbing news about Social Security, and I just want to know if you've heard of this. A few years ago, her father at age 70 filed to collect Social Security, expecting the full amount. He received both a military pension and a pension from the Department of Defense. He paid into Social Security the whole time. Social Security informed him that because he has pensions, he would not get his full Social Security amount, and his benefits were cut by about 30 to 40% of what the estimate had said. This same coworker's husband just turned 60, and he received a letter from Social Security that advised if he receives a pension, which he does, he would not receive his full Social Security estimate when he files at his full retirement age or later. What in the world is this all about? I work for the federal government. I too will be receiving a pension. I pay into Social Security. I've never heard of a reduction in benefits simply because I'll have a pension. Thank you so much for any light you can shed on this. Okay, Cindy, this is called the windfall elimination provision of Social Security, and it can affect how Social Security calculates your retirement or disability benefit. This can often impact those folks who have had a pension benefit coming to them, and it's a complicated formula, but the windfall elimination provision has some carve-outs. And I just looked up on the website. It says the windfall elimination provision, or the WEP, does not apply if you are a federal worker first hired after December 31st of 1983. So I want to make sure that you are checking in with this. It also says an exception is if you have 30 or more years of substantial earnings under Social Security, and it does not apply to survivors' benefits. So I think it's important to get back in touch with Social Security to really understand your specific case or your friend's specific case, and that way you can prepare for it. Sometimes the information isn't conveyed correctly. You want to just double check. This is from Jake, which is a pretty broad-based question, but I'm going to tackle it. Which financial planning company is the most honest, reliable, and most upstanding regarding the client's best interests? Okay, listen, I don't know. This is something you can't just say the most reliable and this, that, the other thing. What we can say is the financial planning firms that are fiduciaries, that gives you at least a leg up. And I think that that's the place to start. That's the types of organizations that put their clients first, put their clients' needs before their own or the individual advisors. That's number one. The next question, he says, which portfolios give you the best growth with the least risk? Come on, man. Who knows? You just have to pick a portfolio that is in line with your risk tolerance. And the next question Jake has is, are there ways to avoid or lessen the amount of taxes paid on your investments? Yes. Absolutely, there is. If you're working with an advisor, that is something that you should be doing every single year, is talking about your tax liability. Your question is it better to invest in precious metals indirectly or with a financial advisor or with a company that deals in gold or silver? I don't know. I feel like precious metals, just buy an exchange traded fund or a metals fund. It's a lot easier to do that. Oh my God, he's got 1,000 questions. The next question is about irrevocable trusts. How are they taxed? An irrevocable trust pays its own taxes. Irrevocable means not changeable. And that trust is outside of estate taxation. So it would fall, whatever asset is in that irrevocable trust is outside of estate taxes, but not income taxes. And last, can your pension money be transferred to a Roth IRA? Well, first of all, your pension money is taxable. And if you then have other income that is earned income, you could use that to contribute to a Roth IRA. But pension income is not considered earned income, so you can't put it straight into a Roth. Whew, Jake, that's a lot of questions you ask. Randy writes, my mother has 4 accounts with Edward Jones, a brokerage, a Roth IRA, a traditional IRA, and another traditional IRA that was used to buy an annuity. She would like to transfer all of these accounts to Vanguard, but she is nervous about the transfer of the annuity IRA. The annuity has been paying monthly for several years now. It's called Bright House Variable Annuity Class A. The reason she would like to transfer is to avoid the commissions and high fees that are charged on the other 3 accounts. Okay, what my understanding would be is that those 3 accounts can be transferred. But if she is receiving the money from that annuity, she's already pulling money out, it is annuitized, chances are she's not going to be able to move it. If that's the case, so be it. Now, you can talk to Vanguard and ask if they will hold that a variable annuity, but they make that decision. And listen, if she has to keep that annuity there, fine. That's fine. Everything else is a straightforward tape-to-tape transfer from one custodian to another. So I just want to be clear about that. Okay, Kara says, I have a very generous pension and I will collect $12,000 to $18,000 in pension payments monthly, depending on how long I choose to work, retirement at 55 versus 63. I contribute a mandatory 5% to this bucket. My current 457 and 403B contributions were all pre-tax in order to reduce my adjusted gross income enough to stay in the 24% tax bracket. I make $224,000 now and I'm single. I'm still saving the max in a 403B as pre-tax, but started putting $6,000 a month into a 457 Roth since I don't have any other Roth. Question, do I need any Roth savings? Should I do more? I have about $60,000 in cash and I just started a brokerage account with $10,000 of that. I've only made enough money to really focus on savings in the last 5 years. But going forward and planning for retirement as early as 2030 at age 55, I'd like to make sure I'm balancing my current tax implications and future tax implications as well as cash savings. I itemize deductions currently and I give away about $15,000 a year, so that also impacts my AGI. Long story short, I know I have enough in retirement because of my pension, which also includes health care, and I will be eligible for Social Security. So how should I rebalance my savings for the short and long term? You know what? I get where you're going here. I don't think this is such a terrible situation. I know that Mark would probably want you to be all Roth, but it sounds like you've got about $250,000 in pre-tax savings. And if that's the case, then we can get that money out pretty easily when you do retire. And one way to get it out, considering that you are charitable, is that you can pull the money out when you retire. You know, you're 55, you'll have enough money to live on from the pension payments, but then you turn 59 and a half, you can start pulling money out. You can actually pull it out as early as 55 if you want. You can pull that money out, make sure that you pay the tax that's due. If that money starts to really pile up, when you're 70 and a half, you'll be able to use your pre-tax money to make contributions through a qualified charitable distribution. So maybe that's the way to go here. I mean, I know Mark wants you to do all Roth, but I don't know. I don't think you really need to worry about that. I feel like we've got many ways to get that pre-tax money out. If you have a big change going on in your life at transition, get in touch with us. Go to JillOnMoney.com and click the Contact Us button. This is the Jill on Money Show.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. This is the Jill on Money Show. We are answering your financial questions. If you have one, go to JillOnMoney.com and click the Contact Us button. Today, we are talking to Miss Melissa, also known as Sweet Melissa for those of us of a certain age, from New York City. Hello, Melissa. How are you?
Hi, Jill. Hi, Mark. How are you?
We are great. What's going on? What brings you to us?
So I have a dilemma. I'm 51 years old. I would like to retire at age 61. So I really only have 10 years that I want to work.
Okay.
I have 3 buckets of money, and I'm trying to figure out what to do with the tax deferred. I think the central question that I have is, in 10 years, I anticipate that tax deferred fund will double. I'm trying to decide if I should drain my brokerage account to Roth convert, or at the age of 61, just spend down everything until age 70 and store the excess in a brokerage account.
Okay, we got 3 buckets. One's a tax deferred. How much is in there right now?
About 1.1 million.
Wow. Okay. And how much is in the brokerage account right now?
About 350,000.
What's our third bucket?
I have just Roth funds between 2 accounts, so it's about 200,000 in Roth funds.
And what about just plain old cash on hand, savings, CDs, that kind of stuff?
I have about a $26,000 emergency fund.
Okay. And Melissa, you're working right now. How much are you earning?
I earn about 130,000.
And you're single, partnered, married?
I'm single with an 18-year-old college student who I do have some 529s, but we're essentially cash flowing her college.
Oh, okay. How much is in the 529s?
About 60,000.
60. And is she in college or a senior right now?
She's a college freshman.
And she did not go, you're a New York person, so she didn't go to Hunter for free. You're telling me, is what I'm guessing.
She actually goes she commutes, so she does go to a city school.
Okay, that's great. So how much does she need per year?
We need about, just tuition alone, probably about $15,000.
Okay, so we have tuition basically carries, is covered by your 529, but there's other stuff?
Correct, like books and
Oh, those books.
all those other
That is
things.
so overrated. How much more do we need a year?
Probably like maybe like $1,200, I would say.
A year?
Between I guess between commuting back and forth.
Let's just say 2,000.
All right, let's say 2,000.
Why not? Okay. She did you a solid.
Yes, she
Can you
did.
imagine? Jeez. All right. So right now, from the 130,000 that you earn, what percentage is going into a retirement account? How much are you putting in there a year?
Right now, I'm putting 15%. I think next year I'm going to up it because I'm on a timeline that I would like to, see it through. I'd like to just finish out the decade.
Just finish the decade. Let's top off the decade. And in that 15%, is that going into a traditional or is that going into a Roth?
It's going into a Roth, and I've been doing only Roth probably for the last 7 years.
Great. That's great. Okay. So on the 130 with the 15% and obviously the kid costs and stuff like that, how's your cash flow?
It's very good. It's good.
So in other words, someone just told me it is impossible to live in New York City on $150,000 a year. You are saying you're calling BS on that. Is that what you're telling me right now?
Well, I should probably mention this is that I don't own a home, and I think that's a big factor. I actually live with my parents, believe it or not. Both of us do, in a 2-family house. So I do pay my parents 25% of my salary, and that's pretty much it.
You pay them 25% of the 130 as like just cover your costs?
Exactly.
I'm interested in this. How is that? How is it like living together? How do you find it? Is it like weird? Is it great? Like where do you stand on that? I mean, it's a real number. I mean, it's as if you were paying whatever $3,000 a month probably or whatever, just under that.
Yeah, I mean, it has its moments, but it is what it is. I think I see the bigger picture, and I try not to let the little things bother me.
I think this is such a smart idea. I really do. And your parents, how are they? How is their, their health, their age? Like, how is it for them?
So far, so good. They're in their late 70s, early 80s. They do have some retirement accounts and Social Security that sustain them, and then whatever I give them, and that's pretty much what we do.
So you and your daughter live in one part of the 2-family house. Your parents live in the other.
Correct.
Okay. And right now, do you have any siblings that would like be mad about this arrangement, or are they okay?
No, they're okay.
Okay. Because they're like, good, you got mom and dad. Great. Keeping eyes on them, right?
Right.
What's the, I know this is going to be weird, but let me just put it out there. So is this an arrangement that like what happens upon their death? Let's just walk through that. They have this 2-family house. Then what happens to you after they die? Do you get right of first refusal to buy your siblings out? Do you stay where you are? What happens?
I foresee my sister moving in with us, and we would own the house together probably. She has some health issues, which would probably not enable her to own the house because of her situation. But if I do own it, then I would probably just own it outright.
Okay, that's great.
Mm-hmm.
So just one sib.
Yeah, just one.
Okay, all right. That makes it a lot easier. Okay, so there's no reason to believe that after, let's pretend they live 10 more years, okay, just for the heck of it, and then they pass away, you're retired. It's not like I have to come up and you say to me, no. In fact, you would inherit this house. You'd have to maintain it. There's no mortgage or anything on it, right?
Correct.
You would inherit it. You'd get the step up in cost basis. You'd live in one half. Your sister lives in the other half. Life is good. Your kids launch, probably not with you, maybe, off doing something fabulous. And you're ready to retire. How much do we think you need in income? It's a funny thing. Like the $3,000 a month is probably like taxes and upkeep and all that. So I'm going to presume that at least your housing is in today's dollars would be that same $3,000 a month. But what else do you need to live on for spending money?
I'm thinking this is just a ballpark number. I'm thinking like between 55 and 6,000 a month at 10 years from now. With inflation and everything.
Let's just say today's dollars, 6,000 a month. That's fine. Okay. So 6,000 is our bogey. Are you entitled to any pension?
No. And I also won't get health care, so I have to figure that out as well.
Yeah, you do. Well, you can go to healthcare.gov and, New York has plans and, that's also a good thing to keep in mind that, you'll have to pay whatever it is, $1,000 a month for your healthcare. Maybe it's a little less, but let's call it that. So that's why I'd rather use 6,000 in today's dollars, which will be fine. All right. What are you going to do with yourself from 61 to 70? You're not going to claim till 70. Is that what I hear from you?
That's correct. I want to try to wait as long as possible only because of this amount.
So I think that I would not convert. I hear what you're saying, but this for where we are today, what we know, what I think the game plan would be for you to keep putting money away. You're doing the Roth. It's great. The tax deferred is going to keep increasing, but from 61 to 70, you got to live on that money and you're going to pull out the money you need. And, if let's pretend it's today's dollars, right? And what I would say is that you would have, $100,000 a year comes out of that tax deferred. You pay your taxes. Now you're living your life. Right.
Right.
And maybe even it's going to probably be like 120 because welcome to New York, the greatest city in the world, but also high taxes. So, if you did that for 9 years, you're in good shape. Yeah. Now, it is possible that like your brokerage account is built up or your needs have changed and you really aren't. Maybe we would think about maybe you would think about converting. But if you're just going to live on that tax deferred money for those 9 years, then you're going to collect Social Security at age 70. Do you know an estimate of your Social Security benefit?
I think right now, I checked it the other day. If I take it at 70, I would get like 4,000 or so.
That's what I figured. And then at that point, you can keep pulling money out of the tax deferred account. You can. And, maybe we would say it depends on the tax rates, depends on what happens. I don't know. But for now, I think the game plan is a good one. This is the Jill on Money Show, and we will be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are having so much fun. I know it's mid-December. You got a lot to do, but maybe you have a question. Just go to JillOnMoney.com and click the Contact Us button. Let's go to Angela. She's on the line from Colorado. So, Angela, what brings you to us?
So my husband and I are both 63, and we are thinking about holding off on our Social Security until we're 70, and we can afford to do that.
That's lucky.
I have longevity in my genes, so I'm comfortable doing that. However, my husband was adopted, so we know nothing about his medical history, so we don't really know what he should do. And I know there's probably no right answer, but just kind of wondering what you two would do in that situation.
So, Angela, is he in generally good health?
Yes.
Okay, so tell us about other things going on in your lives. Like, are you both working full-time?
I am working part-time. He is currently full-time, but hoping to transition to part-time.
How much does he earn and how much do you earn?
He earns a little over $100,000 and I earn about $20,000.
When he transitions to part-time, let's just say that happened at the end of this year. If I give you do it, how much would he earn?
Probably about $30,000.
Okay. And will either of you be entitled to pensions?
No.
Okay. Do you guys have grown kids? Everyone okay? What's happening?
Yeah, we have grown kids. The only thing I can see having to do with them eventually is probably assisting them with a down payment for a home.
Well, why? Do we have to spend your good money to help them? I guess so. This is the difference between being a parent and not a parent.
Yeah, it depends on where they live and what expensive Colorado community they might want to buy a home in.
Right. Okay, well, wait a second. I might have misspoke. Maybe you've got a ton of money. So tell us about the money you have squirreled away for your retirement.
And we have $1.2 million in brokerage accounts. We have $550,000 in pre-tax IRAs and 401ks. We have a small Roth worth $10,000. We have a 529 plan that still has $100,000 in it.
What?
Yeah.
Oh my God. Okay.
We have cash of about $180,000, but about $100,000 of that is earmarked to taxes. We have a home that's worth about $1.9 million that is paid off.
My goodness.
Yeah.
And you want to stay in that house?
Yes, we do,
Okay.
if possible. Yeah.
Okay.
Yeah.
Why do you have such a big tax bill?
Well, I'll tell you that in a second, but let me tell you the other big thing that's on the horizon. I'm about to inherit or be gifted a $3 million annuity.
Gulp. Oh, I mean, I'm not going to look a gift horse in the mouth. So tell me about this annuity. What does that mean? Is the person living?
Yeah, so my mom currently has it. It was my dad's. He passed away and left to my mom. She does not need it. So she is gifting it to my sister and me.
Now, wait a second. Have you run this all by a lawyer?
No.
Okay, I'll tell you why I'm asking that.
Okay.
Annuity products are life insurance products.
Right.
And it's not just so easy to gift things. So I just want to make sure. So your father passed away. It was in his name, right?
Right. Yes.
And then it has already transferred to your mother, right?
Correct.
And is this annuity, this $3 million annuity, which is massive, is that considered a non-qualified or a qualified? Meaning the $3 million that funded this annuity, did it come from retirement assets or non-retirement assets?
Non-retirement assets.
Okay, so it's a non-qualified annuity. And so right now it says hey, it's an annuity in mom's name. And you and your sister are probably the beneficiaries, right?
Right.
Okay. So I guess my question, Angela, is have we talked to the life insurance company that issued this annuity and made sure that you guys can do this?
Yes.
Okay. So you and your sister, you will split. It's $1.5 million each, right?
No, it used to be $6 million. So
Good Lord. Your father was quite the saver.
Yes.
Okay. So it's $3 million each. Okay, there's more questions. This is I just want to know some of the nuts and bolts. Will each of you have your own annuity?
Yes. So
I see what they're doing.
being split into two.
Right. But are they starting, this is going to be annoying for me to ask this question. Are they starting the clock on a brand new annuity contract? In other words, is this now, did we take
Yes.
one? Okay.
Yes.
And is this already happened? This is done?
It's in the process of happening.
Okay. So you're going to have a $3 million annuity. Your sister's going to have a $3 million annuity. It's going to start, it's going to be in your names. And that means that as you take money out of that annuity, it will be taxable to you. The question, I guess, is, are they going to move the cost basis of the original annuity into this annuity? Or do you just start as if you bought a $3 million annuity on your own?
No, they're moving the cost basis.
So there's a big tax hit on this for you.
Yes. And that's why it's being annuitized.
Yes.
And not just taken out as a lump sum. Basically, you retain the asset and you can invest it, and you can also take out, even after it's annuitized, you could take out a lump sum if you want.
All right, but you're probably not going to do that.
No, but and then they would calculate what your monthly payments were if you were to take out a lump sum.
What's your monthly payment based on this $3 million, and when does it start?
It's going to be about $13,000 a month, and it's either going to start in December or January.
Oh my God! Okay, $13,000 a month, and it's taxable to the extent that they'll calculate it for you.
Yeah, so it's going to be about half taxable.
Half taxable, and that's ordinary income, so that means $6,500 a month is your tax liability, right?
Right.
Got you. Jill on Money. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Let's get back to Angela from Colorado. What do you think you need to live on, for real?
I think maybe 10 to 12,000.
Okay. And so, I mean, even if both of you stopped working, just even if, you'd have so much money, right? Because you have $13,000 a month coming in, 78,000 will be taxable to you, but you have so much money. So you shouldn't worry about any of this. I think he has to decide kind of how he feels. You know what I mean? Meaning that, like, if he's like, I'm not ready to retire from full-time work, okay, fine. But, like, he could be part-time whenever he wants, obviously. He could stop working if he wants. You waiting to claim Social Security is fine. I think I would wait till 67 for him, at the very least. There's no need, really. The only reason that, like, you could wait is that you'll get a little more. But if so much money, there's no money that you're going to, like, it's like mind-blowing in some respects. The reason why I probably would wait till 70 is just to start pulling some of this money out of your pre-tax account.
Right,
pay
yeah.
the tax on it just before you guys claim Social Security.
And that's our one thought is,
yeah.
If we can't get that out, we might have him hold off. But
yeah. I mean, it's not going to make such a huge difference, but you know that you have a lot of income, right? You know that you have this, again, let's just say that you're making 50 grand together. You make 78,000 is taxable of the annuity. And we then start to say, okay, wait a second. Let's start pulling some money out of this retirement account. Maybe you're going to pull 100 grand a year out for the next 7 years. You have 550 right now. It's going to keep growing, but maybe you pull 100 grand out. You'll pay it at the 24% tax bracket. But I think that getting the money out of that pre-tax account before claiming Social Security should be the game plan. Absolutely.
And should we put that in a Roth?
Well, you have earned income, right? You still have your part-time income, but I don't think it's necessary. I might just throw it into the brokerage account. I mean, you could do the Roth. It wouldn't be so much for you. It would be like a nice thing to do for your kids. You know what I mean? Like having Roth assets available. But
Right.
I don't think it's not a game changer in any way for you. It really isn't, because you have so much money. You're not going to spend all this money.
I know.
I mean, it's good. It's a good problem to have. So then when you say to me, oh, we're going to help our kids with a down payment, I get it now, because now I see how much money you have. My guess is you'll be able to live off of the annuity income plus whatever part-time income you have. But if you decide to both sort of call it quits, hey, we're not going to have part-time income, so what? I could care less. Don't even worry about that. Pull that money out of your pre-tax account, supplement what you need from, your total for your spending from that pre-tax account. Get the money out. And, if all of a sudden everything is going so great that you're like, oh, my God, Jill, we have a couple $100,000 left in the pre-tax account. Should we just convert it to a Roth? You could. It doesn't matter. You could. Now, the 529, do you have a bunch of kids, or how many kids do you have?
We have 2 kids. One of them potentially will go to grad school at some point.
What about the other one? We can throw it into a, the rule is that you can put up to $35,000 into a Roth for them from the 529.
I didn't realize you could put it into a Roth.
Yeah, that's a new rule that came out. It was the Secure Act 2.0. So let's just say if the money's split 50, is the money 50-50 between the 2 kids, or does one have more than the other?
One has more than the other.
Is that the one who might go back to grad school?
No, actually, it's the other way around. Yeah.
Of course it is.
It's the one that got a bunch of scholarships.
Okay. Well, we don't want to penalize them.
You could transfer the funds into the one that may go back to grad school.
Right. Yeah, that's what I think. I would equalize it, and then,
yeah, that's what I was thinking. And then what you can do is, the way the rule states it is, if the account's been open for 15 years, and I bet it has been, that 529 account.
Yes.
Just about, let's say. You don't have to do it this second, but what the rule says is that you can take the IRA limit for a given year. So let's say it's just this year, 2024. You can put $7,000 into each of the kids' accounts from their 529 this year, and you can put up a total of $35,000 over the next group of years. But that's, I don't know, Mark, is that 35 going to be indexed for inflation with the maximum contribution? I think it seems like a hard cap, didn't it?
Yeah, as it stands right now, it's a hard cap. And also, you get the kid, I'm assuming the kids have earned income, but the kids have to have earned income for the money to go into
Yes, they do, yeah.
So I think that's one nice thing to do for right?
I had no idea it could go into a Roth. That's very appealing.
Yep. And for you, I mean, let's see where they are. Are they married and like household formation? Are they looking to buy homes or not?
Neither are married at this point. And I think eventually they'll both want to buy homes.
Okay. All right. Well, let's see where things stand. But okay, so your initial question was a much easier question than the way I just all got into. So big picture.
This is why you come on the show, because if this had been read as an email, we would have known none of this.
Yeah, exactly. So let's hold off on claiming your Social Security till 70, and let's presume your husband, even as an adopted guy and whose health we don't know anything about, I will rather take the risk of waiting till he's 70. So you've got 7 years. You're going to get that money out of that pre-tax account, pay the tax that's due, and you probably get it out over the next 5 years, to tell you the truth. Don't sweat it if you decide that you're making more money than you thought, or, don't worry about any of this. You've got tons of money. Everything is great. Jill on Money will be right back. You're back. It's Jill on Money. Let's wrap up our conversation with Angela from Colorado.
One more question. When I mentioned that $100,000 of taxes we owe.
Yeah.
So we downsized in January, and we have this big, huge paper capital gain.
Yeah.
In reality, we didn't make a lot of money because we bought another home in the same community. So anyway, we have a capital gain of several $100,000 over our exclusion.
Okay.
And I was thinking of taking some of our very appreciated stock and putting it in a donor advised fund.
Yeah.
Does that work?
Yes. Yes, Queen. I
wow.
love it. Are you charitable?
Yes.
Or are you going to have to gin up some charity? Everybody go be Angela's friend. I would solicit her immediately. It's not her real name. So, yes, I love that idea. When you have a big tax year, using a donor advised fund is a brilliant idea. So you take the lowest basis stock and you put it in there. And, I just had a friend who asked me about this, so I had to look up the rules. One of the things that's interesting is you can put a whole bunch of money. There's no limit on what you can put in, by the way. I mean, if you said, I want to put $200,000 of low basis stock, it goes in there. It goes in as, it essentially, it looks like you're putting the asset into the donor advised fund, but that's not what happens. It gets sold immediately. And then all these big investment houses, whether it's Fidelity or Vanguard or T. Rowe Price or Charles Schwab, they all have slightly different rules about it, because some of them have a rule that you just have to gift every year. Some have a rule that you have to actually make a gift of a certain percent every year. Just be aware of the rules.
Okay,
By the way, did Angela downsize to 1.9 million?
I know. Where was the old house?
The old house was in the same mountain community we live in. And
What'd you sell it for?
Oh, we sold it for almost 2.3. But then we had commission, and now we're going to have capital gains taxes.
But is the new house a better house for you to live in going forward?
Totally,
Okay.
absolutely,
Right.
yeah.
This is the Jill on Money Show, and we will be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's the Jill on Money Show. We are here trying to help you make better or less bad financial decisions, and we do that by asking you to do a bit of work. Go to our website, jillonmoney.com. And by the way, you might as well bookmark that website because our content changes all the time. In the upper right-hand corner, no matter where you navigate on the site, there will be a Contact Us button. All you need to do is click that button and a form will pop up. That is an email that we receive from you. If you think you want to come on the air with us, then just check the box and we can always change your name and protect you. Don't worry. While you're on the website, we encourage you to check out all the great content, including our free weekly newsletter, which comes out every Friday, and I think is a wonderful way to warm up for this show. You'll also see our blog and videos and resources, a lot of great stuff there. So jillonmoney.com, that is your go-to to get in touch with us. Okay, right now, let us start this hour with Erin, who joins us from Colorado. Erin, what can we do for you today?
Well, we're a bit in a pickle of what to do with our finances in this moment.
Okay.
A little background, my wife and I moved here to Colorado after living in New York for many years and being renters basically our entire lives. Mm-hmm. And we bought a house. We bought a house and the interest rate is quite high. We did a 2-1 buy down on our interest rate, meaning the first year we paid 2 points lower, second year 1 point lower, and we just bumped up to that 1 point lower. We're at 6.5% on our mortgage. It's very uncomfortable. But we also had to buy a new car this summer because moving from New York, we only had one car, and it broke. And so we had to buy a new one.
And you need a car. You're not in like the place where you're not catching the M5 to get to work. You're not
exactly
right. Okay.
Very different life.
How much is the house? How much did you pay for the house, rather?
We paid $665.
Okay. what did you put down as a down payment?
Goodness, what did we put down? We put down like 10%.
Okay, fine. And so the rest is financed. And again, 2 points cheaper year one, 1 point cheaper second year. So the terminal value of this loan will be 7.5%. Is that what I'm hearing from you? Okay.
Yes.
And so right now at 6.5%, what happens with your monthly cash flow? You guys making a lot of money? Like, what's going on?
I wish. We are eking by. I would be lying to you if we're in the red a little bit every month because we have 2 small children who are in daycare. We both work full time. And so with our mortgage payment and daycare payments, it's pretty much breaking even or a little in the red.
That's hard to live like that, Erin.
Yes, it is.
Yes,
it is.
All right. So how old are the kids?
We have an almost 4-year-old and a 18-month-old.
Okay. 4-year-old and 18-month-old. All right. So how much do you guys earn together?
Our annual gross income is $250K.
Okay. And are you both contributing to retirement plans right now?
I am. My company does a 1-to-1 match up to 10%. Mm-hmm. And my wife's company does a terrible plan. Okay. So we don't really contribute that much
to hers. But you're putting in 10%?
To mine, yes.
Okay. How much money is in there right now?
$105K.
That's good. How old are you guys?
I am 41. Mm-hmm. My wife is 42.
Let's drill down a little bit on what money you have saved. So your retirement account is how much exactly? Like your retirement plus any other old retirement accounts. Like what do you have all together?
A couple of 401ks, and they total out to $126K. Mm-hmm. We have 2 brokerage accounts, and that is totaling $180K.
Oh, that makes me feel better. Okay, that's good. That does really. You're laughing, but I'm like, okay. What about just money in the bank?
We have about $23,000 just in cash right now.
Okay. And you bought the car. Did you pay cash for it?
We weren't planning on it. So no, we took out a loan. And that's one of my big questions for you is should we pull money from one of our brokerage accounts just to pay it off? Because that interest rate is atrocious.
What is the rate?
9.2.
And what's the loan amount?
$42,000.
Okay. And is that okay? The car loan and the mortgage, is that the only debt you have? I mean, you got like $600,000 in a mortgage right now, but is that the only debt you have?
No, we have some student loan debt.
Talk to me, sister.
$90K student loan
90.
Debt. I know.
Jeez. All right. What's the interest rate on that about?
It's around 6. I mean, there's 6 different loans.
Yeah, at 6-ish.
But they're about 6-ish, yeah.
Okay. So car loan, student loans, mortgage. Anything else? Any credit card debt that's floating around?
No.
Oh, look, she says, no, I passed on that one.
That one I know.
Okay. The brokerage account, you have 2. Is that because you each had one, or is that for was one supposed to be for one thing and one for another? How'd the 2 accounts come about?
I think we started one separately for my wife because she had some old 401ks floating around. We just compiled them into.
No,
yeah,
wait a second. The brokerage account, meaning it's a taxable brokerage account, or are we talking about there are accounts that are holding? Is it an IRA rollover? Here's what I want to understand. I want to know how much money is in a taxable brokerage account. And here's why. The reason I'm interested in that number is I would like to use whatever you have in that brokerage account to try to buy you some breathing room. So it may be, because you said to me we have 401ks, 126,000. Then you said we have 2 brokerage accounts.
Yes.
And I just want to make sure what's taxable and what's like an IRA. That's what we're looking for. So if you're holding the statements in your hand, one should be like Erin's brokerage account. It shouldn't say anything else. If it's like Erin's wife's account, it would be like Erin's wife. It would be like blankety blank for the benefit of, like it's an IRA account for the benefit of FBO, Erin's wife. That's how you would know whether it's a retirement account versus a plain old brokerage account. Any help on that?
I would have to pull that up. That I don't have access to that. My wife does. So,
did you have any? Did you have any money that was just like when you said a brokerage account? Like, did you invest at all, like yourselves? You did.
We work with a brokerage company, but yes, it is all like.
And you've had a brokerage company for a long time?
I would say probably about 5 years.
So we've got some gains in this account, is what I'm.
Yes,
yes.
Yes.
Okay, we'll get back to Erin in just a minute. If you would like to join us on the air, it's very easy. Go to JillOnMoney.com, click that Contact Us button, write us a note, and check the box. Mark will do everything else. You're listening to the Jill on Money Show. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and I know we're winding down towards the end of the year. And this is the time where I think a lot of people are starting to contemplate some New Year's resolutions. I don't love resolutions because it sort of makes it feel like there's an action to be done but not follow through. So I love planning instead. And if you need some assistance in getting started with your planning, get in touch with us. It's very easy. Again, just go to JillOnMoney.com and click the Contact Us button. We might help you prioritize or at least have you see the opportunities that are in front of you. And I think that is so key. When you have agency in the process, when you have some control, you're going to feel better about it. I promise. So get in touch with us. Go to JillOnMoney.com, click that Contact Us button. We'll get you on the show. It's so much more fun when you come on live. I love that part of it. Let's get back to our live conversation with Erin from Colorado. Okay, here's my game plan for you. And anything else that I need to know about other money that's set aside? Do you have rich parents who are going to help pay for college?
If yes.
Yes, I love finally
So the grandparents
the answer to a question that I needed. Thank you. God. All right. Rich grandparents are my favorite kind of grandparents. Okay. So I'm not worrying about funding the 4-year-old and the 18-month-old education right now, right?
We have set aside, we put like $50 in there a month.
All right, stop doing that. We got to clean this up.
Okay.
I'm trying to relieve your pressure. Let's presume that you come back to me and you say to me, Jill, I misspoke. I don't have $180,000 in a taxable brokerage account. We have whatever, $80,000. I'm going to make it up. Whatever's in that taxable account is money that I think we should be looking at to pay off this car loan, lump sum, don't even look back. And I don't even care if there are big gains. I couldn't care less. You guys need to find some breathing room.
Yeah.
Okay?
Yeah.
So I'm hopeful that some portion of that total 180 is something that we can sell and get our hands on. How much did you say is in your retirement plan? 100 and how much?
105.
105 in your current. Okay. Are you stable in terms of like, this is the amount of money you'll be able to make going forward?
Definitely.
Okay, great. When we have a situation like this, here's what I think are the options. One is just to like really help you get some breathing room, as I said. And that would mean selling something that is accessible to you in a taxable brokerage account, paying whatever taxes due, paying off that car, lump sum, boom, done. And that's going to be, I don't know, how much is the payment? Of $500 a month, $400 a month? What is it?
$700.
Okay, so that $700 would be great to relieve you of, right?
Mm-hmm.
Now, the student loan, I'm sort of, it depends how much money you have. At first, I was very excited because what I saw was You have 180. I wanted to sell everything. I wanted to pay off the car and pay off all the student loans and be done and just stop and like give you a moment. But then I have to ask you this question. Do you like this house?
It's our first house. We've been here a year. So, I mean, for us, you're
question.
a New Yorker. Like,
but that's a different question. I'm really asking you, like, truth serum. Do you like this house? Do you want to stay there?
Yeah.
Okay. That's what I need to hear. Because then we'll figure out a way to let you stay there. All right? I'm serious. It's not going to be like you make a lot of money. You know, it's not going to be that you didn't pay $2 million for a house, right?
No, right.
So if we could find, $1,000 a month to give you some breathing room, that is really essentially what we need. Okay. And so the reason why I'm asking all these other questions about like how stable is everyone's job, because if you said to me, well, actually, my job, I work in news media. That's me. And it's, collapsing. And so I don't know if I'll have a job in a year. Then I would be like, just sell the house and move on. Right.
Yeah.
But if you want to save there and you feel like this is the right place, then we have a cash flow issue that we can take care of. All right.
Right.
Okay.
I should also, I'm so sorry, I forgot to mention this about the student loans. We're not actually making any payments right now because we're on the SAVE plan. So there's no payment due until March.
Okay. And when the payment is due in March, what will that be?
$1,000 a month.
Okay.
Yeah.
All right. So of course, unless we get rid of the car loan, then that $1,000 a month is going to just sink you.
It won't feel good. No.
So we got to get rid of the car loan. Priority one, car loan done. And then maybe, again, depending on what you tell me about that brokerage account, my fingers are crossed. I'm crossing my fingers and my toes. Mark, cross your fingers also. If you think that brokerage account, if that is a taxable account, then I think we can probably get you out of this, and at least for the time being. Okay. And, I do think that as much as you are sort of feeling that tightness this second, you will get increases in your salaries. You will, over time. And the next few years are going to be tough. But then the kids go, your 4-year-old has another year before high school?
Oh, God.
Public school? A year or 2 years do we have?
He has another year, but we get universal pre-K soon, so that will relieve a little bit of the.
So we have a 5-year problem, right? We have a 5-year problem, which is in the next 5 years, you'll probably get a chance to refi. May not be like exactly what you want, but you'll be able to get something cheaper than what you have. We'll pay off this car loan. And I have to say, even if you told me that $180,000 that you said was in brokerage accounts, if that were all retirement money, I probably would even think about pulling I can't believe I'm saying this, but I probably would say you should get a 401k loan to get rid of that car loan. I'm worried about March. March is like the marker for me. And we've got to get you some wiggle room between now and then. Car is number one.
Yeah.
The student loans come secondary. You keep putting money into your 10% because you get a 1-to-1 match. I just keep doing that. And don't worry about your wife. Okay. And then over the next few years, as things are relieved, or if you say to me, Jill, it's incredible. We're now making $350, not $250. We'll make different decisions, right? But you don't have to make that decision today. You really don't. Do you guys have estate documents and life insurance and all that fun stuff? Let's talk. Now that you can barely breathe, but is there anything else I can add on to your anxiety level?
No, thank you. We've taken care of life insurance, and we're getting all of our documents in order next week, actually.
Okay, so I'm going to give you some homework, and you promise you get back to me?
100%.
Okay, so I need to know exactly what those, even if you just took a screenshot of your brokerage account statement and just the front page of it, that's all I need to see. I'll tell you quickly what it is. And then we'll follow up with you and give you your short-term game plan. This is short-term, Aaron. You guys have to know that the next 5 years, it's all going to shift. But these are bad 5 years for you guys. But we just want to give you enough. It'll be bad, but if we get rid of the car loan, then, in a year, one of the daycare goes away, right? Mm-hmm. And now things are going to get better and better. And we might even say, don't even pay down the student loans so quickly. We'd rather your wife put money into her retirement plan. But we'll make that decision when we see how your cash flow looks, okay?
Okay.
It's very exciting when you have the whole, oh my God, we have our first house. But, this is the pressure of being a homeowner also. Mm-hmm. So I think that it'll all work out. I think you'll get a chance to refi. It's probably not going to be next year, but we'll get you there. And if we can just, when's our anniversary? When do we go to 7.5% for the loan?
November 1st of 2025.
All right. By then, we'll have a better game plan. We're going to have the 1 year plan. Then we're going to have the 3 year plan. We're going to have a 5 year plan. It's going to be great. And remarkably, you're going to live through it. So take a deep breath, enjoy that Rocky Mountain high, and come back and visit us in New York, will you?
I will. I promise.
All right. If you've got a financial question, it can be education funding, it could be buying a home, it could be retirement, it could be estate planning, get in touch with us. Go to JillOnMoney.com, click that Contact Us button, and write us a note. If you want to join us live, just check that box. It's Jill on Money, and we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. We are answering your financial questions, and right now we are going to take a question from Patty, who writes, Hi, Jill. I have a question about my husband's pension as it relates to income. He was in law enforcement and he's got a pension. That's good. And his pension is taxed. Does this pension count as income as it relates to me investing in a Roth IRA? Meaning, using round numbers, if he makes $80,000 in pension income, I make $200,000 in W-2 income, does that amount exceed the allowance for combined income for a Roth contribution? And the answer is, I think, yes. The range for 2024 is $230,000 to $240,000 for married filing jointly in order to be eligible for a contributory Roth IRA. However, Patty, do you have a Roth option at work? Maybe you could do it that way. Or maybe it doesn't matter. Maybe you've got so much money with all this income and this pension income that you'll be able to save in a taxable account. Okay. Next up, Mary writes, for the last few years, I have done a Roth conversion from my 457 account. Just to note, I am single. Okay. In completing the Roth conversion, oh boy, here we go, Mark. I've stayed within the IRMA limits up to the second tier where Medicare charges 1.4%. Okay. Before we get into these numbers, just as a reminder, gang, here's the deal. Medicare taxes income in a way, or considers income in a way that might shift your cost of paying for Medicare. So there are different tiers, as I count them right now on my beautiful Ed Slot chart. If you are single and you're in that second tier, there is a surcharge that is placed on your Medicare Part B and your Part D. So let me give you an example. In a case, I think what she is saying is the second tier is that if she's single, it means it earning $103,000 to $129,000. So she's converting enough so she stays in that range, which then subjects her to extra charges for Medicare Parts B and D of just under $83 a month. Okay? My question is, should I be converting more money and pay the extra amount of IRMA or not? And I think this is a really important question because so many of you consistently freak out about these IRMA payments. And, it may be that you're so concerned about IRMA and looking past the opportunity to convert your retirement accounts from traditional into Roth. And so let's just pretend that we want to convert more money. How much more will it cost to go to that next tier, which would allow a conversion up to 100? You have to have income up to $161,000, but it's $208 a month. Okay, that means $2,500 for the year. So should you pay an increase of $2,500 to lock in your tax liability and pay the amount of money of tax today? Look, gang, you have to take the money out of these accounts. I don't know how to say it more gently. Required minimum distributions. You're going to have to take the money out. Now, you may be forced to take that money out at a time when you don't know what your tax rate's going to be and you don't know what the IRMA cost is going to be. So my feeling is I'd rather pay the IRMA than worry about where tax brackets and rates are going to be in the future. So, Mary, I would convert more and pay the IRMA. And I hope that helps. But I really think people are so apoplectic about some of the small dollars, and we are really focusing on the wrong thing sometimes when we do that. Okay. Here is Eric, who writes, we are a self-employed married couple, 53 and 52. We've got low taxable income and growing assets after more than 10 years of financial independence. Next endeavor. Question: should we make and can we afford to do Roth conversions? They bring in less than $100,000 a year from various taxable and non-taxable sources. After maxing out the Roth and HSA contributions, they spend all of their income. Cash flow's tight. Here's what they got. Pre-tax retirement, $1.2 million. Roth, $1.4. HSA, $60,000. Brokerage, $175, including $50,000 of cash. Savings, $10,000. The home is worth $375,000. Little mortgage left, $14,000. They've got commercial real estate, which they're using for their business. It's worth $250,000. No debt, no dependents, no debt, no big plans. Cash flow may improve next year. Mortgage payments are going to end in October. Wow. We're also expecting an increase in rental income of $25,000 a year. Can you offer a strategy for us to avoid the looming tax bomb in 20 years? An additional wrinkle, we received the premium tax credit, which was $8,500 last year based on our low income. Well, first of all, I know that you don't want to lose that tax credit for your health care. So I understand that. However, the bigger question is, should you use this money that you have in the brokerage to do conversions? No, don't do it. You don't have enough money right now. I don't want you to lose access to that brokerage account. When you end up looking at your future retirement, one thing to consider would be, maybe in 10 years when, you're going to have that pre-tax retirement, but you have time between, say, let's say you turned 63 and you're 75 years old is when you have to take your retirement distributions. Take the money out then, but don't use your available cash right now. I think that would be a little bit dangerous. We like liquidity. And so I think to have that liquidity is important to you, and it should continue to be important to you. And I think I'd rather keep things as is. If you have a financial question, go to JillOnMoney.com and click the Contact Us button. This is the Jill on Money Show. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
you're back. It's Jill on Money, the program that tries to take the mystery out of your financial life. We do that by encouraging you to go to our website, JillOnMoney.com, and asking us a question by clicking that Contact Us button. While you're on the website, do check out our Jill on Money live subscription service. It's $35 for the next 12 months, but only for 2 more weeks. The price is going up in 2025. So definitely you should check out Jill on Money Live, access to quarterly live webinars for 12 months and the back catalog, all for $35. Okay, right now we are going to take an email. This is from Dave. He was watching us on the Compound YouTube channel, and you should too. Check that out. Okay, Dave earns $185,000 to $205,000 a year gross, and his wife earns about $8,000 a month take home. He's 56, she's 46. They spend about $9,000 a month. They've got $1.7 million in stock plus 3 Bitcoins, has been held for a long time, and $200,000 in money market. So now market's so easy. When I say Bitcoin, I just say, oh, it's 100,000, 300. Great. Okay. No debt except $200,000 remaining on a 3% mortgage. The house is worth $720,000. There are no dependents or basement creatures. I think that means pets. Once stocks hit $2.5 million or 3 years, whichever is first, I'm going to retire. And all my holdings will be left to grow. We'll have an additional $300,000 in a current 401k. It is a completely separate basket resulting from a company sale in 2020. I'm going to tap that $300,000 under the rule of 55 to the tune of $5,000 a month or so to supplement my wife continuing to work. She'll retire later around 55 to 57. Okay. With regard to Social Security, he thinks he's going to take it early. She's going to take it later. He also has a small pension coming at age 65, $1,500 a month just on his life. Now, she has a trust that is building up. It is commercial real estate with a value of $5 million. Wow. It's producing $14,000 a month. Oh my gosh. But we don't know what the equity portion she will end up with. So we kind of write it off as just a bonus. We would be ecstatic to hear your behind closed doors, brutally honest opinion. Pull no punches. I quite understand monetary debasement, inflation. Are we cutting things too close?
Yeah.
I'm not sure. First of all, I don't know what the nature of what's going on for you. You spend $9,000. Okay. That's what you know. I think the issue is that you're 56 and you are producing the bulk of this money. So what do we have to do to look at this? Like, just for fun, one thing to consider would be like, well, what would happen if you drop dead right now? Do you have life insurance? I don't know if you do or not, but I don't think your wife would actually make it on this valuation. I guess if we knew that you had $14,000 a month in revenue or something even less than that, if we knew you were getting something very consistent for her, that kind of helps me feel a little bit sure of your situation. But if we don't include that, it does look like you're kind of close. But do you hate your job? Are you really just freaking out? I don't know. I really want to know a lot more. I mean, remember that let's just say you got $2 million right now, okay, including the Bitcoin, because you can sell the Bitcoin. So you have $2 million. So just think that of that $2 million, if you were going to start pulling money out of that, you could spend 70 or 80 grand a year out of that. So that would be pretty good. And if your wife were to keep working, that would be pretty good. But I'm not sure if it is, I don't know if it's like this, you must retire because you are fried and something's horrible is happening. I just don't know. I feel like you could work a few more years, build this up, and have a lot more security. And maybe between now and then we could learn more about this commercial real estate. Mark, you don't think they can do this, do you?
Yeah, well, I'm not counting on the commercial real estate. If it happens, great. Then we can talk. But until it happens, I'm not even thinking about it. It's very close. It's really close. And by the way, 56 years old, and he's 100% in stocks.
I know, and Bitcoin. So I'd rather you work a little bit longer. I certainly would rather you let everything build up a little bit. And it shouldn't be 3 years or this. It should be you run the numbers, you feel confident. But again, if you come back to us and say, oh no, we are clear, that money in that commercial real estate, that is a done deal. Like there's a long-term lease. Maybe there's like a triple net lease that is really in play. I could feel okay with the plan if I knew more about that commercial real estate. Can we talk to somebody about it? Is that too weird? I mean, I wonder if they're not telling them because they don't want this kind of thing. They don't want them to be calling it quits and moving on. So anyway, I would be interested to hear more from you, and I hope that helps. I wish I could just give you the, thumbs up. And maybe it will be a thumbs up. I don't know. I'm not sure. I am not sure. And until I'm sure, I don't want to give you the complete thumbs up. That's my 2 cents. If you'd like to join us on the program, all you need to do is go to JillOnMoney.com and click the Contact Us button. The Jill on Money Show will be right back. You're back. It's Jill on Money. And before we conclude the show, let's get to another listener email. This is from Mitch, who writes, "This is not a question. It's a comment. I'm a longtime listener and was on the radio show before the podcast." Let me just interject something here. You know, this radio show started in January of 2011. And then the 2 other podcasts, Jill on Money and Money Watch, started in that period of time. So we have some people who cross over to various programs, but all of our content does live at JillOnMoney.com if you want to check it out. So there's that. Okay, now let me get back to Mitch. He writes, "Recently, I listened to the podcast on tariffs and saw you on Face the Nation. A couple weeks ago, I was on Face the Nation, the Sunday of Thanksgiving weekend. So I'm just filling in the blanks for you guys." Okay, Mitch goes on to say, "I would like to suggest that you do a segment on the history of tariffs. People should know that tariffs provided the majority of the federal budget until income taxes were enacted in 1913, letting people know that social needs were primarily provided by the states. This will educate people on the history and why we went to a free trade economy. People need to know that tariffs will increase inflation." Mitch, I love that you want me to go deep into the history of trade, tariffs, mercantilism, the U.S. economy. It's going to be a hard sell for producers. I'm going to tell you that right now, but I get you. What I really want to do is when we have an actual announcement of these tariffs, we can start analyzing that. And yes, we will do many segments on television about that. I'll do segments here on the radio show. We'll talk about it. But until we know what these tariffs really are, it feels very amorphous to me. So I want to make sure we're dealing with what is, not what could be. And as soon as that happens, I promise you, Mitch, we'll be talking more about it. Well, that's it. That is the program. We are so delighted that you join us every single weekend. The Jill on Money Show music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. We ask you to do something nice for someone else today. And as always, change your work, change your wealth, change your life. Thank you for listening. We'll talk to you next week.